What if there was a way to generate passive income while investing in companies you believe in? That's the allure of dividend investments. In this insightful exploration, we're going to decode the intriguing concept of dividend investments and tackle the burning question, are dividend investments really worth your money? Throughout this exploration, we'll be shedding light on the potential benefits these investments can offer, such as the steady stream of income they can generate and the stability they can bring to your investment portfolio. But no investment comes without risk, and dividend investments are no exception. We'll delve into the potential drawbacks, including market volatility and the impact of interest rate changes. We'll also be discussing how to evaluate dividend investments, looking at factors such as the company's dividend history and payout ratio. This comprehensive understanding will help you make informed investment decisions. So let's delve into the fascinating world of dividend investments. Dividend investments might sound complex, but the basic principle is quite simple. At its most essential, a dividend investment is a type of investment where you buy shares in a company that regularly pays out a portion of its profits to its shareholders. This payout is what we refer to as a dividend. So how does this work? Say you own shares in a company. As that company makes profits, it distributes some of these profits back to you, the shareholder, in the form of dividends. Essentially, by holding on to the company's shares, you're getting a slice of the company's success. Now, not all companies pay dividends. Typically, it's the well-established, profitable companies that do. Why? Because these companies have steady cash flows and are financially stable enough to share their profits with their shareholders. These might include large corporations in sectors like utilities, consumer goods, or financial services. Dividends are usually paid out on a regular basis, often quarterly, but sometimes annually or semi-annually. The frequency and amount of these payouts can vary from company to company. It's determined by their board of directors and depends on the company's financial health, profitability, and future investment plans. The beauty of dividend investments is that they offer a way to generate income from your investments on top of any potential capital gains. That's right, you get paid simply for owning the shares. This can be particularly appealing to those seeking a steady income stream, such as retirees, or those looking to supplement their regular income. But it's important to remember that while dividends can provide a consistent income stream, they're not guaranteed. They're dependent on the company's profits, and if the company isn't doing well, dividends can be cut or even eliminated. Understanding how dividend investments work is the first step in deciding if they're right for you. As with any investment decision, it's crucial to do your homework, understand the risks, and align your investments with your financial goals and risk tolerance. There's a lot to like about dividend investments. Let's start with passive income. Dividend stocks are an excellent source of it. When you invest in these stocks, you'll receive regular payouts, typically on a quarterly or annual basis. These payouts come from the company's profits, and you'll get them just for being a shareholder. It's like having a part-time job that pays you for doing nothing. Then there's the stability factor. Dividend-paying companies are often established, profitable entities. They have a track record of success and a history of sharing their profits with investors. This means they're less likely to crash and burn compared to younger, unproven companies. Investing in them can bring a certain level of stability to your portfolio, which is particularly appealing in volatile market conditions. Furthermore, dividend investments are an attractive option for retirees or those seeking a steady income stream. The regular payouts can supplement other income sources such as pensions or Social Security, making them a popular choice for those in their golden years. But it's not just retirees who can benefit. If you're looking to build an income-generating portfolio, dividend stocks can be a key component. Moreover, dividend investments can also offer potential tax advantages. The tax rate on qualified dividends is generally lower than the regular income tax rate, which can be a significant benefit for investors in higher tax brackets. Another benefit of dividend investments is their potential for compounding. If you choose to reinvest your dividends by buying more shares, you'll increase the number of shares you own. And more shares mean more dividends in the future. It's a cycle that can significantly enhance the growth of your investment over time. But as with any investment, there are risks involved. Dividend investments are not a guaranteed path to wealth. The company's performance, market conditions, and other factors can all influence the size and frequency of dividend payouts. But with careful research and thoughtful decision-making, dividend investments can be a valuable addition to your investment strategy. While dividend investments have their benefits, it's crucial to understand the potential downsides. Let's delve into the risks and potential drawbacks of these types of investments. Firstly, compared to growth stocks, dividend investments might yield lower overall returns. Growth stocks are typically those from companies that prefer to reinvest their profits back into the business, fueling expansion and potentially leading to a higher stock price. Investors in these companies may reap the benefits of this growth through increased share value over time. In contrast, dividend stocks are often from mature, established companies that distribute a portion of their profits back to shareholders. While this can provide a steady income stream, it may also mean slower growth and lower capital gains. Secondly, the performance of dividend investments can be significantly influenced by interest rate changes. When interest rates rise, newly issued bonds become more attractive, offering higher yields. This can lead to a shift away from dividend stocks, causing their prices to fall. On the flip side, when interest rates drop, dividend stocks often become more appealing due to their income-generating nature. However, it's essential to remember that interest rates can be unpredictable, and their fluctuations can impact your investments. Thirdly, economic downturns can pose a risk to your dividend investments. During these challenging times, companies may see a decrease in profits, and some may even struggle to survive. This could lead to reduced dividends or, in worst-case scenarios, the complete suspension of dividend payments. Lastly, it's important to remember that not all companies that pay dividends are financially healthy. Some may use dividends to attract investors despite underlying financial issues. Therefore, it's essential to thoroughly research any company before investing. Balancing these benefits and risks is key to making informed investment decisions. Always remember, investing should align with your financial goals and risk tolerance. While dividend investments can offer a steady income, they come with their own set of risks that should be carefully considered. So how can you evaluate potential dividend investments? It all begins with diligent research and understanding the financial health of a company. This means going beyond the surface and diving deep into the company's balance sheet, income statement, and cash flow statement. Look for strong and stable earnings as well as a healthy debt-to-equity ratio. These indicators often suggest that the company is in a good position to continue paying dividends. Next, turn your attention to the company's dividend history. A consistent track record of paying dividends is a positive sign. It shows that the company values returning profits to shareholders and has the financial stability to do so. However, be wary of excessively high dividend yields. They could be a sign of financial distress and an unsustainable dividend policy. This brings us to the concept of a sustainable payout ratio. This is the proportion of earnings a company pays to its shareholders in the form of dividends. It's calculated by dividing the annual dividends per share by the earnings per share. A payout ratio of less than 60% is generally considered healthy. It indicates that the company retains a substantial portion of its earnings for reinvestment while still rewarding shareholders with dividends. Remember, a high payout ratio isn't always a red flag, but it warrants further investigation. It could mean the company is in a mature phase and has fewer growth opportunities, leading to higher dividends. Or it could signal financial trouble ahead. Lastly, consider the company's sector and industry. Some sectors, like utilities and consumer staples, are known for their high dividend yields. They can be a good place to start your search for potential dividend investments. Evaluating potential dividend investments involves a blend of financial analysis, understanding the company's strategic position, and considering your own investment goals and risk tolerance. Armed with this knowledge, you can make more informed decisions about dividend investments. So, are dividend investments right for you? That's the question we've been circling around, isn't it? Let's take a moment to recap what we've learned so far. Dividend investments are a type of investment where you buy shares in a company that regularly pays out a portion of its profits to its shareholders. These payments, known as dividends, can provide a consistent stream of income, making them particularly attractive to those looking for a passive income source or retirees needing a reliable cash flow. Not to forget, these investments often come from well-established, stable companies, which can add a layer of security to your investment portfolio. But like all investments, they're not without their risks. Dividend investments may offer lower overall returns than growth stocks, which reinvest their profits. They can also be affected by changes in interest rates or economic downturns. And let's not forget about the importance of researching a company's financial health before investing. Has the company consistently paid dividends? Is its payout ratio sustainable? These are vital questions to ask before you dive in. So with all this in mind, is investing in dividend stocks the right move for you? Well, that largely depends on your individual investment goals and risk tolerance. If you're someone looking for a steady income stream and the idea of owning a piece of a well-established company appeals to you, then dividend investments might be a good fit. However, if you're more interested in high growth potential and don't mind a bit of risk, you might be better off looking elsewhere. And remember, it's always a good idea to diversify your portfolio, so even if you do decide to invest in dividend stocks, they shouldn't be your only investment. Ultimately, the decision comes down to your unique financial situation and goals. Make sure to weigh the potential rewards against the risks, and as always, consult with a financial advisor before making any significant investment decisions. So we've decoded the complex world of dividend investments. We've seen that they are stocks from profit-making companies that pay out regular dividends, often providing a steady income stream. Especially beneficial for those seeking passive income or retirees needing consistent cash flow, dividend investments can also offer an element of stability, as they often come from well-established, financially healthy companies. However, we've also discussed the potential drawbacks. The overall returns may be lower compared to growth stocks, and these investments can be affected by fluctuations in interest rates and economic downturns. Therefore, it's crucial to consider the company's dividend history and financial health before investing. In conclusion, dividend investments can be an effective strategy for those seeking steady income and lower risk, but they may not be suitable for everyone. Remember, investing is a journey, and understanding different investment strategies like dividend investments can help you navigate your financial future.